Oftentimes, people start investing in real estate in smaller deals. But if you want to start getting into bigger deals where the real money is, you're going to have to answer the question, how to structure a real estate syndication. Syndications make a huge difference in your ability to take your income from where you are investing in smaller deals by investing in a bigger deal through a real estate syndication. In this two-part series, I'm going to walk you through what is a syndication and how do you actually structure it. Structuring a syndication can be very tedious if you don't know the right laws, don't know how to raise money correctly, and don't know which funds to use. But at the end of this video, you're going to know exactly how to do that. And make sure you stick around to the end because I have a free gift for you that is going to help you not only structure your real estate syndication, but make sure you can raise the capital for it, find deals, and start getting some real estate. Let's go. The first question you have to understand is actually what is a real estate syndication? A real estate syndication is when you pool a group of people's money together to buy an asset that neither one of them could buy on their own. And a real estate syndication gives everybody the ability to invest in real estate even if they don't have all the capital to take down these deals. If you really want to scale your real estate business, a syndication is the way to go. And the power of a syndication is it can be used for any asset class. It doesn't matter what kind of real estate you're investing in. Are you doing storage units? You can use a syndication. Are you doing multifamily? If you've been around our channel any amount of time, you know my addiction is to multifamily. If you're doing assisted living projects, you can do a syndication. If you're buying a portfolio, you can do a syndication. Mobile home park, same answer. Any asset class can be done with a syndication, and that's the power of this specific tactic. But if you're going to do a syndication, you want to know not only the power of a syndication, as I just mentioned, but you want to also be aware of the landmines that could go off without you knowing. And in this video, I'm going to make sure you know which ones to avoid. So the three things I want to go over with you in this video will help you not only structure your syndication, but actually make it happen. And the very first thing you have to understand is the difference between a 506c fund and a 506b fund. Inside the United States government, there's an SEC, or a Security and Exchange Commission. It's simply a branch of the government that polices these types of securities. Because when you're doing a syndication and raising money to buy an asset, and since you're selling a security to your investors, the Security and Exchange Commission polices that and makes sure that everybody's doing things above the line and doing it correctly. Nobody's being taken advantage of, and nobody's investing in something in which they really don't know what they're investing in. So in the Security and Exchange regulations, under Reg D, there are two funds in which we, as real estate syndicators, can raise money under, a 506b fund and a 506c fund. Now, both of these funds have some similarities, but they're very distinctly different in a couple things that you have to make note of. If you raise money from investors and you start an incorrect fund and don't do it correctly, you could be fined or even worse. It's really important that you're raising money under the right fund to make sure you're doing it correctly. We always say, without the right fund, you remove the D, which removes the fund. Here's the point. When we're doing real estate, we're not doing it correctly of how we're supposed to do it. It always ends up badly. And so especially in these funds, before you just start asking people for money, make sure you go through and take notes of the difference between a 506c fund and a 506b fund. The first thing is a 506b fund basically means you can take money from non-accredited investors. Now, what's an accredited investor? An accredited investor has three specific distinctions. They either make over $200,000 a year in their income, or $300,000 in a household income if it's a joint income household, or the third thing is they have to have a net worth above $1 million. And if one of those three things are in place, you have an accredited investor. And in a 506b fund, it allows us to raise money from people that aren't accredited. The power of that is you can start leveraging your network of aunts, uncles, friends, your chiropractors, your service providers, people that you know you can start raising money from if they don't have $1 million net worth or make over 200 grand a year. So it gives you the ability to raise money from many more people. This is a powerful fund to raise under, and quite frankly, it's where most people start in the syndication world. And I would suggest to you, if you're gonna do a syndication, start with a 506b fund because the number one difficulty people have in syndications is raising capital. And 506b allows you to raise money from essentially everybody. But there's a big stipulation when I say raising capital from everybody. But in the SEC laws under Reg D and the 506B fund, it specifically states you have to have a pre-existing substantive relationship with anybody you take money from. What that means is if you're going to accept money into a syndication, you have to have a relationship with that person first. Again, now I'm not an attorney, I'm not an SEC attorney, and I would encourage every single one of you to consult your attorney to make sure you're doing this exactly the right way. But make sure you know, you can raise money from non-accredited investors, but you have to have a relationship ahead of time. Now you might say, what is ahead of time? Ahead of time what? If I meet somebody yesterday, I have a relationship with them ahead of time, but ahead of what? What happens in real estate, when you make an offer on a piece of real estate, your database freezes. After you put that property under contract, you can't form any new relationships in which you take money from. You have to have a relationship with them before you go under contract. A lot of this may seem subjective to you, and quite frankly, it is. But it's clearly stated in the SEC laws, you have to have a pre-existing relationship before you ask them for money and present a specific deal to them. But the 506B fund lets you raise from non-accredited investors. But when you get those non-accredited investors, you have to have a relationship with them. There's a second stipulation to a non-accredited investor. They can certainly be non-accredited. You have to have a relationship with them. That's thing number one. But the second stipulation is they have to be sophisticated. Now you might say, Mike, what in the world is sophisticated? A sophisticated investor is just somebody that understands the process and has invested before. So if you do have a relationship with them and they're brand new to real estate, they've never even invested in anything, they have no idea how real estate works, the SEC is really strong against not taking money from individuals like that because they want to make sure you're accepting money from people who know exactly what they're getting into. So the 506B fund, you can raise money from non-accredited investors, but you have to have a pre-existing relationship and they need to be sophisticated and have an understanding of what they're getting into. There's another thing you need to know with the 506B fund. You cannot generally solicit your offering. Meaning, if I put a piece of multifamily under contract, I can't go on Facebook and say, hey, just put a piece of property under contract. Would anybody like to invest? That's considered a general solicitation. Under a 506B fund, you cannot generally solicit because you have to have a pre-existing relationship. And if you already have that piece of property under contract and then you're marketing, most likely you're going to get people into that funnel and you're going to attract people that you may not have a relationship with. So you can't generally market and do general solicitation for any type of real estate investment in which you're syndicating inside a 506B fund. Now again, 506B fund is my favorite fund because it opens up the world of possibilities for investors. Your parents that have $50,000 that want to invest in your deal, they might not be accredited, but they know investments, they can invest in your deal. And not only leveraging family, but also leveraging college friends and friends in your network and your service providers. You can now raise money from anybody as long as you have a relationship with them. 506B fund is where I would encourage you to start. Now, the second fund is the 506C fund. This fund is actually much cleaner and much clearer to communicate. In 2012, the Obama administration ushered in another fund under Reg D, which is 506C. And it's very clear. They wanted to finally give investors like us the ability to market our properties. So they said, okay, you know what? In a 506C fund, you can do general solicitation. You can put a property under contract. You can set up some Facebook ads and say, anybody who wants to invest in this property, come on down. Literally, that opens up the world of possibilities for raising capital. You can put a piece of property under contract and you can start marketing that property day one and raise the money much quicker. So you can only take on accredited investors which have one of those three stipulations, meaning they make $200,000 a year, $300,000 as a household, or they have a net worth north of $1 million. If one of those things is true of your investor, they are accredited and can come into your fund. Now, with a 506C, because it only takes accredited investors, it also requires going through a third-party verification company. What that means is a company will verify that your investors are actually accredited. Somebody may say, yes, I have a net worth of $1 million, but they may not actually have a net worth of $1 million. So these third-party companies verify that your investors are actually accredited investors. They have to prove their net worth, prove their assets, or prove their income. So these third-party companies protect you and help do the verification process for you. They do charge a fee for that, so the more investors you have, that will usually be a little bit higher, but they do the work. But in a 506c, you have to have a third-party company do the verification so that not only you're clear, but it's actually a law under the 506c offering. If you're going to syndicate, these are your two options. 506b fund, you can take money from non-accredited investors, but you have to have a relationship and you can't market. 506c fund, only accredited investors, but you can do general solicitation. Now, a lot of my syndicator friends actually love the 506c fund because they can market their properties, and 506c accredited investors tend to be a little easier to work with. If you're investing your last $50,000 in real estate, you're often much more stressed out than if you're investing from a larger pool of capital and you're an accredited investor. You're often more relaxed and you trust your syndicators a little more. So you can decide which is best for you. If you're starting, I would definitely start with a 506c fund, build your database, build your reputation, then you can move over to a 506c fund when you have the reputation and the track record to put that kind of fund together. Before I get to the last two tips and your free gift, please consider subscribing to our channel. We love growing our family to continue to help more people get into real estate. At PowerUp Real Estate, I have one goal: to help 10,000 people get a piece of multifamily real estate. I would love that to be you. Make sure you subscribe to the channel and smash that thumbs up button so you can continue to get our videos and we can continue to play a role in getting your next piece of real estate. Let's get back to the video. The second thing you need to decide in a syndication is what fees are you going to charge. I would suggest when you start off, try to keep your fees low so it gives you a leg up on your competition. Because when you're first starting off and you don't have the track record, you have to have another reason for people to invest in you. And so I would keep your fees low. Now, when you're syndicating, there are three major fees you can charge. And yes, there are some other fees that can be added in, but there's three big ones. The first one is an acquisitions fee. This is one of my favorite fees. This is actually a fee you charge all of your investors for finding and putting together the deal. You found the deal, you've called all the investors, you've raised all the capital, you talked with the lender and the lawyer and everybody and got everything together, and you've done the due diligence and you've looked at all the leases and you've put property management in place, you've done all that work. Well, how do you get paid for that? Well, there's an acquisition fee that gets paid at closing. So you can actually charge your investors anywhere from 1% to 4%. I like when you're starting off, do 1% for your first two deals, then scale up to 2 and 2.5% from there. If you're going to go to 3 or 4, you usually need to have north of 1,000 units to charge that kind of fee. But your first fee is an acquisitions fee, and it's a powerful fee. On $1 million deal, you can get a $10,000 check at closing. At 2%, a $20,000 check at closing by you doing all the work. The second fee is an asset management fee. An asset management fee is something that's charged throughout the life cycle of the deal. You charge 2% is usually a typical asset management fee. You can scale that up if there's more work involved, but an asset management fee pays you to manage the manager. You're going to have a property manager in place for whatever kind of real estate you're investing in, and they're going to take care of the day-to-day. They're going to make sure the rent's paid. They're going to make sure that the people who are renting out your storage units, that they're paying on time, and if they don't pay, that they get their stuff out. They're going to manage all that process. Well, who's going to manage the manager and make sure that they're doing their job well? You are. Who's the manager going to call when something goes wrong? They're not calling your investors, they're calling you. So we charge a percentage so that we can make sure we're being paid for the amount of time we're putting into the deal. And I like to start in that 2% range. And that's 2% of gross income every single month. So you can charge 2% of gross income because you're doing so much work on the property. So not only an acquisitions fee and an asset management fee, but there's also a disposition or a refinance fee. So let's say you're going to sell the property or refinance the property and take the capital out of the property. Well, that's a lot of work working with the bank, making sure it gets an inspection, making sure it gets an appraisal. Since you're managing all that, you can also charge the same as your acquisition fee on the exit of the property. It's called a disposition fee. So if you charge 1% for your acquisition fee, you can charge 1% for a disposition or a refinance fee for doing all that work. And these are the fees that keep you in business in real estate. A lot of people think in real estate you only make money from the monthly income in your equity in the deal. It's not true. We actually charge fees to make sure we can keep our lights on while we're finding more deals. And the third thing you need to decide is what percentage you're going to give to your investors. How are you going to split up the percentage between the money you get and the money your investors get? And people ask me this all the time, Mike, how much money do you give to your investors? Here's the hard thing. There's really no right answer because the deal dictates every single decision. So if the numbers are really strong and we're making a ton of money, I might go 60-40, 60% to my investors, 40% to me. If that cash flow goes down a little bit, I'm going to go 70-30, 70% to my investors. If it's even lower, I might go 80-20. I know a lot of syndicators that start at 100-0. They give 100% of the cash flow to the investor for year one until they get the property up to health, and then they take equity from there. Since they've charged fees, and you should too, they've earned some money so they can justify not taking cash flow year one and just giving that away to the investor. But where I would start on most deals is 70-30. Give 70 to your investors, you keep 30. But if the deal is really tight on cash flow to start, but you're going to see strong appreciation over time, take yours down. Take yours down to 10%. Give them 90. Make sure that your investors are incentivized to come into the deal, and they will be more incentivized the more equity you give them. And you can do a scaled equity, which is how we do it. We often start at 70-30 year one. We go to 60-40 year 2 and 3. And when we sell it, we exit at 50-50. We do a scaled model to make sure the investors aren't seeing a big dip in their cash flow every time we change. So we give ourselves time to raise up the income, then we take more equity. It's called performance real estate. We get paid more when we perform. And investors like that. They like the fact to know that we get more when we perform, so there's incentive for us to do a really good job on this property. So I would start off at 70-30 with your investors and see where the numbers turn out. And then based on your project, you can move forward with whatever percentage would be an incentive to your investors. Because there's a lot of information here, I want to give you a free gift to make sure you can continue to learn how to get into the real estate game through syndication. I have a free multifamily masterclass that I created to help you get into multifamily real estate. So you can click the link in the description and you're going to be taken to our 60-minute free training that'll give you the 5 upgrades you need to start busting into real estate right now. I'll see you in the next video.